Hey folks, this is Carl Lindgren, Director of Financial Planning here at Stabler Wealth Management. Thank you for joining me today for the estate planning update for 2025. We wanted to just bring you a few updates. Washington State, you may have heard, recently made a couple of changes to their estate tax laws, as well as some changes to their capital gains tax laws. So I wanted to bring you those changes, as well as some strategies to minimize estate taxes. Now, what I want to start with are just a few key terms. So, the first term that you might hear in the estate planning industry or conversations is the term estate tax exemption. Now, basically, what this is, it's just the portion of a person's estate that they can leave to other people or heirs without triggering any estate taxes. The second term is going to be portability. Now, this term is essentially the ability for a surviving spouse to inherit the estate tax exemption from their deceased spouse, right? So, what that can do through portability is that surviving spouse can then have double the exemption amount. The third term you might hear is lifetime gifting. Now, what this is essentially just gifting over and above the annual exclusion amount, which for 2025 is $19,000. Lifetime gifting, of course, as we'll go into in a moment, can be really helpful for people who, where it doesn't necessarily affect their sustainability, want to bring the value of their estate down. They can potentially look at lifetime gifting. We'll talk about it in a little bit. And then the fourth term that we're going to see today is credit shelter trust. And so a credit shelter trust is a vehicle to essentially to provide a surviving spouse with access to assets without actually those assets being included in their estate. Essentially, what that does is it allows the deceased spouse or the first to pass to use their estate tax exemption while still allowing their surviving spouse to access those assets in the event that portability is not available. So looking at the key features comparison for the new estate tax law for Washington State. So on the left side, you'll see the old law. So a lot of you might be familiar with some of these numbers. The estate tax exemption for several years now has been just under $2.2 million per person. There has been no portability in Washington State. And so, like I said earlier, what that means is that if an individual passes away, their spouse can, of course, receive the entire estate and all of the assets, but they cannot receive that deceased spouse's $2.2 million, or in this case, I guess it's $2.193 million exemption. So that surviving spouse would be worth, potentially double the amount as a single person and still only have their single exemption. For estate tax brackets under the previous law, they ranged from 10% to 20%. There were 8 brackets in total. And then, as I mentioned before, that lifetime gifting was not included in the calculation. So, for federal purposes, what the US government does is they actually look at your lifetime gifting and they pull that back into the equation for federal estate taxes. For Washington State, they do not do that. So under the new law, the changes are essentially what we're going to see is that exemption amount is going to increase from 2.193 million up to $3 million per person. We are still going to see no portability. So that still requires that bypass trust to be really useful. We're going to stay with 8 estate tax brackets. However, they are now going to range from 10% to 35%. And the lifetime gifting will still not be included in the calculation. Now, you might have noticed there's one thing that I didn't mention yet, and that is the inflation adjustment. So the reason that we've been sitting at this 2.193 million exemption for several years now is because technically the exemption amount was tied to an inflation adjuster. However, that inflation adjuster was not being updated anymore. It was kind of defunct. And so under the new law, they are tying it to a real active inflation adjuster. So going forward, we will see the exemption amount adjusted for inflation going forward. Now, if we dig in a little bit deeper and see exactly how the old law and the new law compare, what you can see is again that the change between the old law exemption amount and the new law is just over $800,000. So what that means is that a person can pass away with an extra $800,000 now estate tax free. From there, anything beyond the exemption amount is going to be taxed at 10% on the first $1 million beyond that exemption. That's not at all a change from the previous law. So essentially, anybody with up to $4 million will see lower taxes in that situation. I'll get into in a minute exactly what the break-even ranges are, but going forward, what you can see is each of those brackets, the dollar amounts are actually staying the same, right? So you've got the exemption amount, the first million, the next million, the next million, the next million, and so on. And what you can see is that the ranges actually increase. So initially, that first 10% tax stays at 10%. The next million, we see a 1% increase from 14 to 15%. The next million, we see a 2% increase from 15 to 17, and then a 3% increase from 16 to 19, and so on until you get up to the highest level where we see an increase from 20% to up to 35% on anything over, I think it's about $9 million of taxable estate. So doing a deep dive now on just a theoretical $10 million estate, we can kind of look at how this affects someone under the old law versus the new law. Now, this is someone who's not making use of a bypass trust, so this is just assuming an individual with a $10 million estate in either situation. So under the previous law, the exemption amount being 2.193, they would have no tax on that amount because, again, that's the exemption. The next million, they'd see a 10% tax, $100,000. The next million, a 14% tax, $140,000. So on and so forth until you've exhausted that entire $10 million. And the total tax on a $10 million estate under the previous law would have been just over $1.25 million. Now, under the new law, what you're going to see is a $3 million exemption amount with no tax. The next million taxed at 10%, $100,000. The next million taxed at 15% now, $150,000, and so on and so forth until that $10 million estate is exhausted. And in total, the total tax on that $10 million estate would be about 1.3, a little over $1.3 million. So slightly higher than the tax under the previous law. Now on the right, you'll see a line graph here. And essentially what this is the break-even point for a single estate, showing on the left there, kind of in that blue color, the previous law, where you notice it starts to creep up right at about 2.2 million. And then the new law, you actually see certain estates are actually going to save money under this new law. And the break-even point for a single estate is right around $9 million. Essentially, anybody under $9 million, you'll probably actually pay less in taxes, estate taxes. Anybody worth over $9 million, including the exemption amount, will pay actually a little bit more in estate taxes. Now, for couples utilizing a bypass trust, of course, they would get the additional exemption amount at 0% if they're doing that. The break-even price or the break-even estate size at that level is closer to about $14 million for a couple utilizing a bypass trust. So looking at, just as an example, at a $5 million estate, right? So this is in force through June 30th, 2025, the current estate tax laws. Again, the exemption's 2.193. We've got a range between 10 and 20. Over on the right there, you'll see, including the exemption amount, kind of where the ranges land or where your estate might land. So a $5 million estate would be subject under the prior law, or technically it's the current law through the end of this month, to about $360,000 of estate taxes. Looking at the new law, which takes effect July 1st, The updates here are that, like we looked at before, the new exemption amount is $3 million, and the range is now range from 10% up to 35%. You'll notice in there as well the federal estate tax. The tax on that is 40%, but the exemption amount's much, much higher. The exemption amount in federal estate tax is like $13.9 million dollars. It's very, very large. A $5 million estate under the new law would only be subject to $250,000 of estate taxes. And so you can see there's about $110,000 of tax savings for a $5 million estate under the new law. So what this means is that if anybody's planning on passing away sometime soon, if you're worth over about $9 million, you might want to do it sooner rather than later. And if you're worth under 9 million, hang in there for at least another few weeks, okay? So I think in terms of key takeaways for the estate tax update here, as we've looked at before, there is still no portability, right? So using a bypass trust is still very prudent in estate plans for couples. Lifetime gifting is still excluded. So a lot of times we want to look at, for example, giving money to heirs before somebody passes away because we know that's not pulled back into the equation. Obviously, the thing we want to pay really close attention to there is, can we actually afford to do so? We, of course, don't want to give away more money than we can afford to give away and still live our lifestyle just to avoid taxes. It takes effect July 1st, so we've got a few more weeks with the current law before this new law takes effect. And importantly, it will be inflation adjusted going forward. Over on the right, this chart kind of just shows how different estates will be affected. So again, an individual or a couple not using a bypass trust, under 2.2 million, or a couple who is using a bypass trust under about 4.4 million, you won't see any change. And again, the reason you won't see any change is because no estate tax due before, no estate tax due under the new law. The second range here for an individual or for a couple not using a bypass trust, the range between 2.2 and 9 million, or a couple who is utilizing a bypass trust between about 4.4 million and 14 million, you're actually going to see lower taxes. And then for any individual worth over 9 million and for any couple utilizing a bypass trust worth over 14 million, you will see higher taxes under the new law. So let's talk about how to use a bypass trust and why it matters in Washington state. So again, the estate tax exemption is not portable in Washington state. So like I mentioned earlier, the ability to utilize that for somebody, kind of essentially the first spouse to pass, is really important. What a bypass trust does is it essentially allows the first to pass spouse to distribute their estate into this trust to then support their surviving spouse as long as that surviving spouse is alive. But it allows them to use their exemption amount. And the reason that it allows them to use their exemption amount is because they are ultimately deciding what happens with those assets once the surviving spouse passes away. So everything that ends up in the surviving spouse's estate, that of course they can decide wherever they want to leave that, right? And so in a pretty typical situation, what you might see is, a married couple, let's say they have 2 kids, and their estate plan may say, hey, I want to leave everything to my spouse, and then after my spouse passes, I want everything to be split between our children. Well, their surviving spouse, anything in their estate, they can change that. They can say, you know what, maybe I don't want to leave this to my surviving children anymore. Maybe they want to leave this to charity. Through the bypass trust, that will support the surviving spouse, but they cannot change where that goes at their passing. And that, again, is what allows the deceased spouse to make use of their exemption amount. A couple of things to think about when utilizing a bypass trust. It's really important just in practice that we get the proper account titling, because any beneficiary designations or transfer on death designations are going to supersede survivorship designations. They're going to supersede whatever it says in the will. And so if your will makes use of this bypass trust, but you've kind of undermined that through your designations that are going to override your will, then unfortunately that bypass trust won't be able to be funded. And so it's really important that we get the proper account titling, our beneficiary designations are set up properly, and that we allow disclaimers where necessary. So the way that a bypass trust works, and this in this example, we're looking at a $7 million estate. Let's say that the first spouse passes, and by the way, and this would be under the new law, so not the current law that's effective through June 30th. This is the new law effective July 1st. So let's say that the first spouse passes and they want to essentially leave the entire estate, the access of the entire estate to their surviving spouse. So they would fund a bypass trust with the $3 million estate tax exemption. The remaining $4 million would go directly to the surviving spouse, and then they could live off of both, right? So that surviving spouse would obviously have access to their $4 million. It would be theirs. They would also, through being named the beneficiary of this bypass trust, have access to those funds as well. Now there can be some limitations, so it's of course important to talk to an estate planning attorney, talk to a financial planner about how that might work. But in general, this is kind of the structure that helps to avoid the estate tax without giving up too much too much in the way of access or putting too many restrictions on. And then when the second spouse passes, they of course have their exemption amount as well. And so anything over 3 million would be subject to the Washington state estate tax. But they again could make use of lifetime gifting by giving away some of that money in their estate in order to avoid that if necessary. So if we look at a case study of a couple, Jack and Jill, right? They're worth $5 million. They've got a home in King County worth about $2 million, no debt, maybe a 500,000 recreational property in Eastern Washington, and then of course a $2.5 million portfolio with Stabler Wealth Management, right? Without a bypass trust, if Jack passed away, left everything to Jill, Jill is now worth $5 million, right? Now, when Jill passes away, her estate would be subject to $250,000 of estate tax. Essentially, the way that works, she gets her $3 million exemption. The $2 million difference goes through those brackets, right? 10% on the first million, 15% on the next million, 100,000 plus 150,000, 250,000 of estate tax in total. With a bypass trust, when Jack passes away, he leaves his half of the estate, right, $2.5 million, to a bypass trust for Jill. Under the previous law, he would only fund it with 2.193 as opposed to 2.5, just because the exemption amount would have capped him at that. Now, he could certainly leave more, but it wouldn't make sense to leave more. Jill now is only worth $2.5 million, and so when she passes away, there is no estate tax due. So for a couple worth $5 million, you can see how under the new law, this bypass trust strategy saves them $250,000 of estate tax. Now, under the previous law, the current law through the end of June, actually that savings would have been even higher than that. So we'll talk about lifetime gifting again. So again, Washington state only counts the assets in the estate at death, and they do not pull back in lifetime gifting. So for federal purposes, you're allowed to give away $19,000 per person per year, right? So couples can kind of double up a little bit. And it's totally fine if you exceed that. If you exceed that, however, if you exceed the 19,000, all you'll have to do is just file a gift tax return. And essentially what you're telling the federal government is, hey, I gave away more than the exclusion amount. So you're going to take this off of my lifetime gifts. You're going to take this off of my exemption by the time that I pass. And so for federal purposes, what they do is they look at the value of your estate plus the value of your lifetime gifts, anything in excess of those exclusion amounts. They add them together, and if they're over that exemption amount, then you're exposed to federal estate tax. For Washington state purposes, they're only looking at the value of your estate at your passing. They're not looking at the value of any gifts that you've made. So again, this is this is a very important strategy because while the bypass trust strategy is it makes a lot of sense for many people, it can be expensive to set up, it can be expensive to administer, and to the extent that it makes sense with your financial plan and your values and your goals and wishes, gifting can make sense as a slightly more cost-effective way to pass assets to heirs estate tax free. So again, the federal estate tax exemption for 2025 is just shy of about 14 million per person. Amounts over that are subject to that 40% tax. Now, federally, the estate tax exemption is portable. There's a couple of forms that you have to fill out if your spouse passes in order to inherit that exemption. So what that means is that a couple could pass away with close to $28 million, but it does pull back in any lifetime gifts, right? So in the example below, what you see is, if somebody gives away 119,000 to someone else, that's totally fine. That 19,000 will be the exclusion amount. The $100,000 difference would just take off from what you theoretically could pass with then at that point. And so you would have 13.89 million of your lifetime federal exemption left. And again, that wouldn't affect your Washington state estate situation at all. Another way to reduce estate taxes is through charitable gifting. So this can potentially have a dual benefit. So of course you can do it during your life, right? That reduces the size of your estate. There's also tax benefits to doing so. Again, just like gifting to family, it needs to be something that's actually, a desire of yours, right? You have to be able to afford to give away what you're intending to give away, and be able to, survive and have a nice sustainable plan even after you've given those assets away. There's some really neat tools we can look at using, right? Donor advised funds, qualified charitable distributions. Those are essentially ways that we can kind of save income taxes and potentially reduce estate taxes through charitable gifting. And then, of course, using IRA beneficiary designations if you do have a charitable desire to leave assets to some sort of a charity or nonprofit organization at your passing. It might be worth looking at making them a beneficiary of your IRA. And the reason is because, as an individual, if an individual inherits an IRA, they ultimately are going to have to take that money out and pay tax on it. However, if a charity inherits an IRA, they don't necessarily have to pay tax on that, right? They can inherit that. It'll go directly to them. Because they're a nonprofit, they don't pay income tax on that. And in that way, you can kind of avoid both estate tax because there is a charitable deduction in the estate tax calculation. Anything left to charity is not included in that calculation, and also avoid the income tax on when those assets come out of the IRA. So jumping into the capital gains tax, again, we saw some changes to this as well. So under the previous rules, there was a $270,000 exemption. It is inflation adjusted when they set that a couple of years ago. It started out at 250,000. We've seen that slowly increase. Now the exemption is 270. And so for Washington for Washington state capital gains tax purposes, if you have less than 270,000 of capital gains, you don't need to worry about paying Washington state capital gains taxes. If you have over 270,000, you may need to pay Washington state capital gains taxes. It's a 7% tax on any gains over that exemption. Although it excludes, the big exclusion is real estate, right? We obviously, living in King County, there's a lot of embedded gains in our real estate here. And so that's the kind of the main big exclusion. There's also some other exclusions in there for small businesses. Looking at the new law, now this notice is retroactive to January 1st. So again, when we looked at the estate tax, that takes effect July 1st. This capital gains tax is retroactive to January 1st of this year. So that 270,000 exemption still holds in place, still inflation adjusted. We still see a 7% tax on amounts over that 270,000. However, they now added an additional surtax of 2.9%, so a total of 9.9% on any taxable gains over a million, right? So essentially you can think of it as you get 270 tax free. The next million, you would pay 7% on the next million. And then anything over that 1.27 million in total there would be taxed at 9.9%. Still excludes real estate, has all the same exclusions, although it does now allow for up to a $100,000 deduction for charitable purposes, which was not there before. So in terms of next steps, I think really good for everybody to take a look at their estate planning documents, make sure that they're up to date, make sure that if you're in that range where you might be subject to Washington state estate taxes, look at making sure that you have a bypass trust or that you have a plan to minimize that. Review account ownership, titling, beneficiary designations, make sure that everything is going to flow properly. Talk to your estate planner, talk to your financial planner. We want to make sure that nothing in terms of titling or survivorship options on any accounts are going to override a really well thought out estate plan. And then, of course, we can look at estate tax projections under the new rules, figure out how that might affect you personally, and consider gifting if it's appropriate. So wrapping up, again, that new Washington state estate tax, there's going to be a few changes there. I think the main takeaway is that it's going to be good in the sense that we're going to see it adjusted for inflation going forward. We're seeing a higher exemption amount, and then it will potentially affect people over about 9 million individuals who aren't using a bypass trust, or 14 million for couples using a bypass trust. It will affect them negatively if they're over those amounts. But anybody under those amounts will potentially see lower taxes. We looked at how to use a bypass trust, also called a credit shelter trust. There's other terms that kind of get thrown around with that one: credit shelter trust, disclaimer trust, marital trust. You might hear a lot of those. And then, of course, just kind of understanding Washington state's new capital gains taxes. So again, I think it's great to check with your financial planner, check with your estate planning attorney, see how these changes affect you and if you need to take any steps. Another thing to think about too, if there's anybody else in your life, family or friends that you think would find this interesting or might be affected by this and you think that chatting with us would be helpful to them, please don't hesitate to introduce them to us. We're always happy to, chat with anyone and hopefully help set them in the right direction. To that, I hope everybody has a great rest of the day, and feel free to reach out if you have any questions or want to talk through how this might affect you. Thank you.